Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Scott Bauer. Hey there, Scott.
Jeff, how are you?
I'm doing great. It's really interesting to see markets continue to rally, and we have all the eyes on the Fed and their future expectations of interest rate hikes. What will they actually forecast tomorrow, and what are you anticipating in the market?
I don't see any change whatsoever. I think the dovish speak that we've seen is going to continue, and we probably still move a bit higher, though I think we start grinding a little bit.
Well, the Fed's really talking about the dot plots. Are those dot plots really going to move?
No, I don't believe they will. They're in my opinion, still going to extend out to the end of the year, saying we're not going anywhere.
All right. Well, Scott, it's time to get in that first lightning round. Are you ready?
Absolutely.
Too much, too fast. Well, it was really interesting to see. Just last week, we saw the tech sector, specifically the NASDAQ 100, up nearly 5%. So my question to you is, are we seeing the markets get out in front of this Fed messaging this week?
Yeah, I really think they are. And Jeff, I'm really looking to harness the rip higher in the E-mini NASDAQ 100.
Well, how would you potentially approach this? Because we have seen just an about face from December 24th. We're up about 2,000 points in the NASDAQ 100. Yes, I said that right. Up nearly 2,000 points. So how do you express a view? 2,000
is right. And a way to potentially express this view would be by selling an EOM end of month 7,500, 7,800 call spread in the E-mini NASDAQ. And in this example, an investor could sell that call spread to define the risk and collect about $535.
Well, this is really interesting. So the June E-mini NASDAQ 100 was the underlying here, and this trade example was priced out around 73.88 in the future, but the at-the-money volatility all the way down to 15. We've really seen a vol erosion, if you will, Scott. What is your approach here as you're just seeing it? Is it going to top out, or is it just too much too fast simply?
Well, as you said, Jeff, vol is really at the low end here. So this is really just a directional type of setup for an investor looking to the fact that maybe the NASDAQ has topped out in the short run.
Well, that's really interesting. And also remember, in May, we will be able to further talk about diversification of portfolios because the launch of the micro E-mini contracts are coming out. That's 1/10 the size of that E-mini NASDAQ 100 future contract, Scott.
Absolutely, and again, that for the average investor, that's really going to help with liquidity and put a new product out there.
Oh, I agree. And please remember, these are trade examples, not trade recommendations. Let's move into the second lightning round.
All right, let's do it.
Oil rush. We have seen just a move higher. It seems like across every asset class, it is risk on, Scott.
It really is. What haven't we seen rip higher here? And oil space is no different.
And interesting to see that $60 level we talked about seems to be a lot of resistance. But at the same time, I want to approach my trade example with the volatility really being subdued. So I want to be a buyer of a put spread in crude oil. I'm buying the March week 5 56 put, and I'm selling the 54 put. In layman's terms, I'm buying a put spread here. It's very inexpensive to put on this type of risk mitigation to the downside, and it's only going to cost an investor $130, expiring on March 29th.
Absolutely, and like you said, volatility is so low. So the futures contract here is trading at 59.25, and at the money volatility was 25.39. So the break-even point on this setup is 55.87 when we price this trade.
And I think it's important to understand all these trade examples, the way we approach them. Yes, we've seen a lot of asset class rally here, but the supply-demand equation that comes back in, we're producing a lot of crude oil here. So I think crude oil remains in a range. Would you agree with that?
Yes, and albeit we may be at that upper end of the range, but definitely range bound.
All right, Scott, great having you here on Striking Options. We also want to thank you for tuning in. Please tune in every week as we will continue to strike options.